QuickBooks Online 2021 forward contract for speculation that foreign currency will weaken initial transaction within QuickBooks. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our QuickBooks Online multiple currencies problem 3 practice problem. In prior presentations, we turned on the free 30-day trial and then turned on the multiple currencies. Now we're going to be entering the initial transaction. Let's first open up our financial statements by going to the tab up top, right-clicking on it. We're going to duplicate that tab. And then I'm going to duplicate again, right-clicking on that tab and duplicating again, opening up the profit and loss and the balance sheet. Going down to the reports on the left-hand side, let's first open up the profit and loss report, the good old P and the L. P and L report. We'll do the date range change up top. We're going to have our year 1 be in 2000, so it's going to be 010120 to 12/31/12/31/20. We're going to go ahead and run that. Nothing's there thus far. And then we're going to go to the tab to the left, open up the balance sheet, go into the accounting or reports on the left-hand side. This time the BS balance sheet report opening up. Date range change up top from, we're going to put this in 2000 again. So we're going to say this is going to be from 010120 to 12/31/20 and run it. And I'm going to close up the hamburger. Then we're going to go to the tab to the left where we will enter the transactions. Let's check it out in Excel to see what our scenario is. We have a forward exchange contract where we're going to be, the 5,000 pesos is what we're looking at. And it's going to be a 180-day forward exchange contract. We put it on the books so that we're going to be receiving the 5,000 pesos in the future. That then is going to be the one that's going to be in the foreign currency, the accounts payable. Then we have a receivable on the books, which is just going to be for cash. We used the current exchange rate, but not the spot rate, but the forward contract rate in order to put this on the books. Now, in the last time when we put this into QuickBooks, we did so with basically a journal entry, and we assigned these two accounts not to accounts receivable and accounts payable accounts, but rather to other current liability and other current asset type of accounts. This time we'll use the accounts receivable and accounts payable, and it'll be a little bit different. There's some pros and cons to doing it. It's a little bit more difficult to do the initial transaction, but it might help us with some of the currency changes over time. So in order to do that, we're going to put a receivable on the book for the exchange broker as a receivable type of account this time. We're going to then put a payable on the books for the exchange broker and then we'll enter it into the system with two transactions that will use forms, an invoice and a bill, so that we can then enter it in and track it in the receivable and payable. So let's take a look at that. We're going to go back on over to QuickBooks. Let's first turn on the multiple currencies or add the Mexican peso here. So we're going to hit the drop down and we're going to go then to the currency list and we're looking for the peso. So I'm going to add another item, hit the old drop down and I think it's MX peso, MX something. There it is, MXN. So we're going to pick up the MXN. I'm going to add that. So now we got the currency that we're going to be needing. Now let's go then to our accounting down below. We're going to go into the accounting and note that if I was to try to set up like an accounts receivable and accounts payable account, if I said new up top and I look say for an accounts receivable type of account, then I don't have anything for a foreign currency kind of account here because basically that's going to be driven by the customer. And if I do, as opposed to last time, we did the other current assets where we do have this ability to change the currency here. So we're going to use the accounts receivable and accounts payable, and to set it up, we'll simply add a vendor to do this. So what I'm going to do is I'm going to add a customer and a vendor for foreign currency related to the broker. So I'm going to go then down to let's go to the sales item. Let's add the receivable side of it first. And so I'm going to go then to the customer and let's add a customer for the receivable. So I'm just going to say add one customer. We could do this as we create, say, the invoice as well. So I'm going to call it broker and the US dollars. Let's call it broker customer US dollar, because we're going to have a broker vendor as well. This one's straightforward. We don't need to change the payment options down here. So this one is going to be in US dollars. It's going to be the accounts payable side of things, where we're going to have the other side that is not going to be in the US dollars. So I'm going to go ahead and save that. So we'll save that. And then the other side of it, we want to then be on a payable. So we're then going to go, let's go to the expenses side. And I'm going to add another vendor. So I'm going to go to vendors here. And we're going to say, let's add a vendor. Add a vendor. And this is going to be the broker. And this is going to be vendor. And then the peso. And the peso. And then this is the one where we got to change the currency. So now I'm going to say this is going to be in a foreign currency, not US dollars, but the MXN Mexican peso. So we got the MXN Mexican peso. So that is set up. And remember that obviously, as we saw before, not quite obvious, but we saw this before, is that if you had transactions with the broker that are going to be in a foreign currency and in the US dollars, then, or in the case of a broker, we might have multiple foreign currencies. I'm going to have to set up a new broker, transaction for every different currency that we're going to be using it for. Because that's what, if we're going to be using the broker to be calculating the accounts payable. So I'm going to then say save it. And so there we have it. Now I'm going to put these two sides on the books with an invoice and a bill. And that will basically clear itself out. So I got to do the two sides of it, because what I want to be happening is that I can then go through the normal kind of form process, and that will help us to then enter the adjustments to the currency or the payment of this thing at the end of the process. So I'm going to create an invoice with an item that's going to go to like a clearing account. So what I'm going to do is I'm going to say I'm going to make an invoice here, and we're going to set up the invoice. And this is going to be to broker. We're going to say broker 1. Now you can probably set this one up as a journal entry as well, but I'm just going to use the actual form to do this, which is an invoice to increase basically an accounts receivable account. This one's in US dollars, so it's fairly straightforward. We're then going to say that this is going to be on 10/1. I'm going to say X0 for year 1. So I'm going to say this is on 10/01/20. And that's going to be our first year transactions for our practice problem here. And then I'm going to set down an item down below so that it then doesn't go to a sales account, a revenue account, but rather goes to a clearing account. So this will increase the accounts receivable. The other side, I want it to be going to the broker account, the payable, but I'm going to have to do this with two transactions. So these two transactions, these two forms are going to net out in what I'm going to call a clearing account. So I'm going to then set up a clearing account. I'm just going to say this is going to be an add another item here. And this is just going to net each other out. It's going to be a service item. I'm just going to call it a service item. And I'm going to call it broker clearing account. Clearing account. That'll be the description here. So I'm going to put that in this description down below with our item. Now here's where the change is. It's not going to be going to the sales account, but rather we're going to put it to another kind of account, which I'm going to call a clearing account. Typically, I would make this account either a other accounts receivable or an other accounts payable, as opposed to an income type statement account, because I don't want it to roll over into the equity section. We're going to then say this is going to be an other asset. I'm going to call it a broker clearing account, and we'll keep this in the US dollars. Saving it and closing it then. And so there we have that, and I'm going to save our item, and then we're just going to pick the amount that we said it was going to be for the 3,700, so 3,700, and there we have it. Now in practice, you might do the payable first to let the software kind of help you out with the calculation of the exchange, but even then, we're not going to be able to use the spot rate, so we'll have to use the forward rate. So we'd have to kind of calculate out the 3,007. This is going to be increasing the accounts receivable. Other side going to that clearing account. So let's save it and close it. Save and close. And then if I go back to then the balance sheet, run the report, refreshing it, holding control, scrolling up just a little bit to that 125%. Accounts receivable now going up, and the other one's in this clearing account instead of going to the income statement. So income statement is still at nothing involved on the income statement. This one will go back down when I do the same thing for the payable side. Payable going up, and then the other side going to the clearing account to remove this one netting out back to 0. And so we're going to go back to the first tab. We're going to now set up a bill. So let's go to the drop down. This is the form that would typically be used to set up an accounts payable type of account. So we'll do the consistent process with that, because when we use the pay bill, that will help us out with the multi-currency. This is the one that has the foreign currency transaction. We're doing this side of the journal entry, by the way. If I go back to Excel, we're doing this side of the journal entry. So now this rate would give us the rate if we were using the spot rate. But again, even though we're using this date at this point in time, even if it was in practice, we couldn't use this rate within QuickBooks, because in this case, we would have to use this forward rate, which we would have to get from the broker, because this is a forward exchange contract as opposed to the spot rate, which is today's rate. So we're going to assume that that rate was given to us at that 0.74. So we're going to say this is 0.74. Obviously, this is a lot different than the current exchange rate at that point, but it's a practice problem. For practice purposes, that's not the actual exchange rate at that time. So then we're going to go down and we're going to say this is as of 10/1/2020. Other side, I'm going to go to that account we just set up again. Accounts, let's say, what did I call it? Broker clearing account. There it is. So the broker clearing account, that's where the other side is going to go. So when we enter this transaction, it should increase the accounts payable, and then the other side is going to go to the broker. Let's put the dollar amount here. That might be useful. Here I'm going to put the full 5,000 pesos, and we have the currency exchange then giving us that 3,700. So in other words, if I go back on over here, we're going to say that we're going to get 5,000 pesos. We're using that current exchange rate, which is going to give us that 3,700. This is why you might want to do the side that is the foreign currency first, in this case the payable, to help you with that calculation, the 3,700, and then do the receivable side if you use this method. Although either way you go, you're still going to have to kind of change the rate up top to do the calculation, because we're not using the spot rate, but rather the forward contract rate. This will increase the accounts payable. Other side going to the clearing account, which should take it back down to 0. Let's go to save and close. Saving it and closing it. Back to the balance sheet, running it again to refresh it. Hold down control. I'm going to scroll up back to that 125. Now we got the accounts receivable on the books, clearing account back down to 0. So it just went up, it went down. Then we have the accounts payable on the books. This is the one we're going to keep our eye on closely, because this is the one in the foreign currency that we'll have to change. Now that we have it in accounts payable, although it was a little bit more difficult to do that with than just doing a journal entry and not using account receivable and account payable type of accounts, when we end this thing, QuickBooks will do the calculation of the exchange gain or loss for us a little bit more easily. And so that's one of the benefits of using an accounts payable type of account as opposed to an other current liability. So we'll see the differences there. Nothing's happening with the income statement over here. No change to the income statement if I run this report. And so let's go ahead and open up our trial balance at this point in time. Good old TB trial balance. Trial balance. Running it. And do the date range change up top from 01/01/20 to 12/31/20 and run it. Close up the hamburger. So we just have the 3,700 accounts receivable and the 3,700 accounts payable. That's what we have over here on Excel as well. We have that 100,000 that we want to keep in cash just as a starting point. Let's go ahead and add that too, just so we have that. So I'm going to go back to the first tab. I'm going to just let's go down to our accounting. And we're going to add then a checking account, because we don't have a checking account, and just put 100,000 in it that we can use in our practice problem here. So we're going to add another account. It's going to be a bank type of account. It's going to be a checking type of account. Checking, and I'm going to call it in the US dollar. And so there we have it. It's going to be in the currency of the US dollar. So we'll keep it there. I'm going to save it and close it. Let's put 100,000 in there so we can do some mess around with the 100,000. Good old. And we're going to then put the 100,000 starting point. It's going to be a deposit. So we'll make a deposit as of, let's say, 01/01/20, beginning of the year 1 that we're working in on. And this is just going to be our beginning balance numbers, 100,000. And the other side going to equity, I'm going to put it to retained earnings. Retained earnings. So that's just going to increase our cash. Other side going to equity being our beginning balances. Let's save it and close it. Then if I go back then to our trusty trial balance, run it. Now we've got our 100,000 in the checking. We got the retained earnings. So 100,000 in checking retained earnings and the accounts receivable and accounts payable at the 3,007. That should match up what we have here on our Excel worksheet. It does. So we look good. And so we're going to go ahead and print out these trial balances for you if you want to check your numbers as you go through the practice problem.